battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show, episode 213. It feels so good to be back. We are back in the studio. Let not your heart be troubled. You were wondering, Nick, where is the studio? Where is Producer O? Where is Katie the Greek? And I have great news. We are all back. Katie the Greek is here. Producer O back in the building. We've got slides for you to kick off our first episode back in the studio in a few weeks. So it's going to be a great show. Thank you for being here. And we are going to cover the World War III trade today. Yes. I think there is a World War III trade going on. I don't think we're going into World War III, but before we get into it, don't forget to subscribe to the show on YouTube. It helps us get it to more and more people, or Apple or Spotify, wherever you're watching. And the last announcement I want to make is October 8th and 9th in Oak Brook. That's our Investor Day conference. You cannot miss this thing. Pre-registration is filling up very, very quickly. You are going to make the biggest mistake of your life if you don't register for this thing. And I'm telling you, I'm not trying to oversell you on this. You absolutely have to come. You have to go to Investor Day. And I'm telling you, you will make the biggest mistake of your life if you miss it. We have Tom Lee headlining, former head of research from J.P. Morgan, and he's absolutely incredible. We've got a number of excellent speakers coming to you live October 8th and 9th in Oak Brook for Investor Day conference. Okay. Let's jump right into it. Here we are. It's a 2% correction in the market. Producer O, if you don't mind, throw it up on the screen here. February of 2026, almost done with the month, and we are in a 2.2% correction. Some of you are having a meltdown. You are having a panic attack. You are thinking about jumping off the ledge. And what do I keep showing you? The data mass statistics, and here you go. 2.2% is nothing. October 25, just last year, we were down 5%. Don't forget Liberation Day with the tariffs, down 19% in the S&P. March of 2024, down 5%. July of 23, down 10%. It keeps going. December 21, March of 2020, everybody remembers COVID, almost 6 years ago now, if you can believe that, down 32% in 2 weeks. September of 18, May of 15, April of 2011. This is not an exhaustive list, but it is a pretty darn good list to show you the corrections that have happened and to put this current pullback into context. So yes, you do have some stocks that are significantly off their all-time highs, which I will show you in a second, but I just wanted to give you a little update of what's happening in 2026 now and what I would call the state of the market. Producer O, if you can throw this up on the screen for us. Look at the top 50 of the S&P. That's that first line there, down about 3.63% for the year. Look at the S&P, down only 0.11%, 2.2% again off the all-time high. The 400s, the mid-caps, up 7% this year. The small caps, that's S&P 600, up a little over 7% again this year. EFA, that's international, up almost 9% for the year. Europe up almost 7, China up about 1, Japan up about 12 or 13. And you're thinking, Nick, you always told me that the U.S. is going to be the best place to be. Clearly, you're wrong. Look at those numbers. And I say, when in doubt, zoom out. And if we can go back to that slide here, look at the 5, the 10, and the 15-year numbers. Not even close. And if I would have had you in small mids, Europe, China, Japan, for the past 10 or 15 years, you would have been upset in the opposite direction, saying, why in the heck were we in China for the past 15 years? Why were we in Japan for the past 15 years? Why were we in Europe for the past 15 years? Why were we goofing around with over-leveraged small caps for the past 15 years? So just put things into context for a second. And everybody who says there's going to be this mean reversion, we're going to go back to Europe leading the way for a while or Japan leading the way, maybe. I could be completely wrong. I don't know for sure. I don't have a crystal ball. Crystal ball on the shelf here from Amazon doesn't really work. Wish we had a real crystal ball to tell us. So who knows exactly what the future holds. But betting against the top 50, the top 100 of the S&P 500 is like betting against the New York Yankees. They don't win the World Series every single year, but they get pretty darn close. They're a pretty good team. It'd be like betting against the Seahawks or the Patriots, show up in almost all the Super Bowls. So just be careful of subscribing to this idea that, oh yeah, we should be going out and buying these so-called value trades, because that's really what's going on this year, is it's more of a value trade. If you peel back the layers of the S&P and the top 50, it's heavily dominated by big tech. You've got NVIDIA, Apple, Google, Microsoft, Amazon, Broadcom, Facebook, Tesla. You've got Berkshire and JP Morgan. But what I want to call your attention to here on the right is the sector breakdown of the top 50, obviously heavily dominated by technology. Technology is about 43% of the top 50. And I want to just point out a couple other sectors, one being industrials, only about 2% of the top 50. Energy, only about 3%. And so this is going to be important as I show you a few other slides here of what's going on with the rest of the market. But just remember, the market is made up of all these companies. So we want to understand that the market is not just an index. It's not just this ETF or this portfolio you're buying. It's a portfolio of companies. That's the key. And if you get into the international index, here's MSCI EFA. Here's the top holdings in EFA. You've got ASML. You've got Roche, you've got AstraZeneca, Novartis, you've got HSBC, the bank, you've got Nestle, Toyota, Shell, the oil company, Mitsubishi, and Siemens. But look at the difference here when you get into the sectors. Technology is only 9.5% of EFA. Industrials is 20%. And so what's happened in 2026 and the past 12 months, really the past 18 months, is industrials have really taken the lead. Anything that's been basically a defense contractor, anybody that's been making materials and basic goods and manufacturing and everything else, those companies are doing well. And actually, if you look at the industrials within the U.S. itself, U.S. industrials are outpacing their European counterparts. So it's less about European leadership the past 12 months, and it's more so about industrial leadership. So wherever you have an index where industrials are heavy, they're a heavy presence, you're going to do well. You would have done well, I should say, the past 12 months. Same thing with healthcare. Healthcare is finally getting a bid, did nothing for the past 3 years, and now it's coming back in a big way. Healthcare is a larger piece of international than it is of the U.S. right now. So that's what you're seeing. It's not just international leadership, and it's more so a subset of sector rotation, which I've called your attention to the past couple episodes now. We even did a show called Sector Rotation. It's the lifeblood of a bull market. So again, yes, you're going to see times where technology doesn't do that well, and that's happened in the past, but you're also seeing times where other sectors rotate to the top, and one of these would be financial services. In fact, if you were going to pick between the EFA index and the top 10 holdings there versus the S&P's top holdings, you're going to pick up a few banks in both indices. You're going to pick up either JP Morgan in the top 10, like I showed you in the top 50 of the U.S., or you're going to pick up HSBC in the top 10 of EFA. And I would make an argument, again, not stock advice. I'm not telling you to go short HSBC and buy JP Morgan, nothing like that. But what I would say is over the next 10, 15 years, if it's my money, I'd rather have my money in JP Morgan than HSBC, because that's what you're doing when you trade the U.S. and go buy international. So again, it's not to say you're not going to get a bid on some of these international stocks. It's not to say they're all bad companies. They're not. But what we're looking for is long-term structural growth. And we're looking for great companies at a good price. And actually, when you get into Europe, yes, it's true that PEs, relatively speaking, are a little bit lower than the U.S., where you might trade the U.S. at 24 times earnings, whereas you might trade Europe at like 16 or 17 or even 18 times. But when you actually compare European valuations now to themselves the past 5, 6, 7, 8, 10 years, what happens is you see that actually European stocks are more overvalued today than they've been for 5 years, even than U.S. companies have been. U.S. companies have been hovering around this 22 times forward earnings multiple the past 5, 6, 7 years, whereas European companies have almost doubled their valuations. A lot of them are up 70, 80, 90%. Some of them are up almost triple, depending on what companies you're looking at. So mostly what's happened in Europe has not been earnings expansion. It's not been profit growth. Rather, what it's been multiple expansion, which doesn't necessarily mean it's a structural long-term trend. And that's what I want to be very careful of in the portfolio as we manage money for Stenger Family Office clients, is we actually want to look at the fundamentals of the business. We want to look at cash flow growth. We want to look at revenue growth. We want to look at profit margins rather than just earnings or rather multiple expansion. EPS expansion is more important than PE expansion, which is what you're seeing in some of these international markets. So again, pockets of good companies. There are a handful of good companies. However, by and large, what you're doing when you go buy these indices is you are selling some sort of U.S. counterpart to do that. And that's where I think you have to be a little careful. Now, here's what's happening with large, mid, and small. I showed you the chart before where small and mid caps are doing better than large caps and certainly the top 50 in 2026. There's about a 10% spread on owning a small cap versus a mega cap this year. However, here's what that is attributed to. Large caps, if you look at the breakdown of where the return is coming from, large caps are 33% technology, whereas small caps, mid caps are less than 20%, and small caps are only 14% tech. Again, more heavily dominated by banking, finance, and also industrials again. So you're seeing that bid, you're seeing that sector rotation go towards industrials, go towards some smaller healthcare startups and things like that have not done well for the past 10 years. And now all of a sudden they're finally having a catch-up trade in 26 because of sector rotation, not because small caps have all of a sudden become more profitable, but rather because of the makeup of these indices. So I believe what's going to happen, if you look at the S&P today, yes, technology is in a correction, and I'm going to show you the specific stocks that are causing that correction, but once we get past this correction today, I believe what you're going to see is large caps are going to regain their dominance over mid and small because, again, fundamentally, these companies have not really changed. They took out loans during COVID. They never should have taken out at 0 or 2% interest rates. All those loans are resetting on 5 and 7 year arms, similar to a mortgage. And now, all these small and mid caps are financing debt 7 to 8 times higher, or 3 to 5 times higher in the case of a mid cap, than they were during 2020. That is a major, major problem. You have a company like Traeger, which, again, not stock advice. I'm not telling you to go buy it, short it, anything, but I just want to use Traeger as an example. That was the company during COVID where everybody was sitting at home, didn't know what to do, bored out of their minds, and they buy a Traeger smoker and they start making meats, and they're smoking briskets at home. And Traeger at one point was priced like they were going to sell every household in America 3 smokers. Well, clearly that didn't happen. But management at the time went out and they took out something like $550 million of debt to make smokers. And you're saying, why in the world would a grill company need $550 million of debt? Well, they didn't. It was just cheap money at the time, and now it's all they're paying the price for that in a significant way. And Traeger stock is down at basically a record all-time low, probably on the brink of bankruptcy is my guess. But you have to be very careful looking at the specifics of the small and mids because, again, the fundamentals have not really changed a whole lot the past 5 or 6 years. And there's a reason why when you go back to that first chart that I showed you, small caps have underperformed large caps and mega caps by 2 or 3 to 1 the past 15 years. It's again, just the idea of a market cap weighted index, meaning the biggest companies rise to the top, the biggest companies gain a higher share in the index. It's just common sense that over time, the biggest and best companies rise up from the small cap, from the mid cap indices, into the large cap, into the mega cap indices. And mathematically speaking, when you look at the top 100 stocks of the S&P, your return is really being driven by the top 10 or 15 or 20 stocks anyways. So you would really have to make a big bet on a small cap or a mid cap stock in the portfolio for it to have a meaningful impact on return. Otherwise, if you get it wrong, you're going to underperform. And that's exactly what's happened to a lot of investors the past couple years as they've looked at these target date portfolios and all the rest. Now, let me show you this growth and value trade one more time. This gets into a little bit more of the U.S. large cap. This is the S&P 500 on the left. You've got EFA in the middle. That's international again. And then you've got small cap U.S. I just wanted to pull this in as an example as well. You can see where the growth and value is on the style box. Look at U.S. large cap. U.S. large cap naturally has a little bit of a tilt towards what's called blend, but some of these blend companies actually were considered growth companies too. So naturally what happens is U.S. large cap is already going to have a slight overweight towards growth. Growth is the problem right now, temporarily in 2026. But if you back out 10, 15, 20 years, growth has been obviously the clear winner. Whereas in EFA, in international markets, that middle style box, you're seeing an overweight, and actually a significant overweight, towards value stocks. Value is getting a bid. if you look at the U.S. market today, just the S&P 500, and you separate out growth and value, actually a lot of U.S. value companies are outpacing most European counterparts. Same thing with the past 12 months. Value's just had an absolute ripper of a year. And so that's what you're seeing underneath the surface of this market. And then you go to small cap. Look how heavy value stocks dominate the S&P 600 index. It's most of the S&P 600 in that 39% range. Plus you add in some of the blend money. You have a overweight towards value in small cap. So again, this is not necessarily a small cap trade. It's not really an international trade. What this is it's a value trade. And why are we having a value trade? I think that's the biggest question that we have to answer. There's a couple competing narratives right now. One is this idea that that AI is going to drop off a cliff and everything's going to blow up and AI is in this huge bubble. I believe that there are certain companies in the AI world that are absolutely in a bubble, but I don't think it's every single company that touches the AI universe that's in a bubble. I think there's plenty of companies out there who have been completely thrown aside, that have traded off 50, 60% now from their all-time highs, which I will show you in a second, that should not be trading 50 to 60% off their all-time highs. In some cases, valuations have got cut in half. And so there's this narrative out there that says because the Fed is being a little bit stubborn on interest rates and because valuations have been so high, the market is going to come collapsing down because of this AI bubble. And there is some truth to that again in some elements of this. There's some stocks that are extremely overvalued still, even after their corrections, but I don't believe that's true for the rest of the market. I think rather what you're seeing is what I would call this World War III trade. And that's why we named the show the World War III trade, because really what you're seeing is all the doomsday prepping type stocks, the value stocks, gold and silver. I'm going to show this to you in a few slides from now. But all of the things that you would do before we go into a nuclear Armageddon are up. Everything, building a bunker in your backyard it sounds like a great idea this year, and stocking it with canned food and gold bars and everything else. That's been a great trade in 2026. So that's, I think, really what's behind the scenes here is you're just seeing people trade growth assets and what we would call more optimistic assets for assets that they think are going to protect them in a downturn. So before I show you that, I just want to look at these three pieces of technology. I showed you the layers of technology in the last episode, but what I wanted to do too is just separate out some of the names here of what's happening. Remember, you've got big tech companies like Microsoft, Amazon, Google, NVIDIA, Apple, and Meta. Those are the companies that have real earnings, real cash flows. And yes, they have traded at slightly higher valuations than the rest of the market the past couple of years, close to that 30, 35 range on the PE ratios. Absolutely true. But these companies are real businesses. They have massive amounts of revenue, massive amounts of cash flow, massive balance sheets, and they've been relatively well insulated from all the different changes that have happened in tech the past 20, 25 years now. And I would also argue if these companies can make it through a situation like COVID, they probably can make it through this sell-off in AI, because these companies, again, yes, they touch AI, but that's not their whole business model. The companies that where AI is their entire business model, I think that's where you have to be a little more cautious, and that's going to be what we would call emerging tech, like Anthropic, not a publicly traded company, OpenAI, not publicly traded. Many of these companies aren't publicly traded yet, but when they do publicly trade and they IPO, they're going to come out at ridiculous valuations. I would expect 500 multiples on earnings, maybe even 1,000, maybe no multiple on earnings, meaning they're not profitable. Those are the companies where, yes, they're helpful tools and they could have some revolutionary results down the road, but it would be like buying some of these companies in 1999 at the peak. Maybe they're still around 25 years, but for investors, there's just not a whole lot of return left because the valuations are so high. They're great businesses, they're real businesses, but again, multiples are just way too high. Then what you've got, and I think this is the most challenging part 3 here, is these SaaS providers, software as a service. And those are the companies where they have sold off, they've got real business models, but some of them are probably due for even a further correction before they ultimately find their bottom. And those are companies like Adobe and DocuSign and Salesforce and HubSpot and Bill.com, ServiceNow. All great companies, all got have very good earnings and very good cash flows and everything else. However, we could be like catching a falling knife, and I'm going to show you an expanded list of that as well. here's some of the companies that I think if you look at, again, nothing here is stock advice. I'm not telling you to go do this or buy or short or anything like that, but I just want to use this list as an example. You're seeing companies here like Oracle down 57% that was trading at a 35 or 40 price to earnings multiple, now trading at a 17 multiple, which is basically like a bank stock. You're seeing Robinhood here trade like almost like a value stock in the financial services world. Schwab for years traded at 30, 35 times earnings. Robinhood is even higher growth than Schwab, and they're trading for 26 times earnings with 27 million customers. You've got Netflix down 43%. You've got Palantir, yes, not overly valued like a Oracle or like a Robinhood, for example, but Palantir is about half of the valuation it was a year ago. It's about a third of the valuation it was 2 years ago. So you're seeing this massive, massive correction in tech. Look at CrowdStrike, the cybersecurity provider, down 36%. Its valuation has gotten cut in half. And then there's Microsoft here down 30%, if you can believe that, with a forward P of 24 with some of the most stable revenues that you could ever find in the S&P. You got AMD here, which is actually getting a bid today, up about 9 or 10% last time I looked. But as of yesterday, was down 26% at a 32 forward. So those are the companies. I'm not saying they're screaming buys. I'm not saying you couldn't get hurt buying them temporarily. But to me, those look like the companies and some of the examples of overreacting to this AI idea that it's going to take out everything on planet Earth. So here's the companies, if we pivot to catching a falling knife, I think these are the companies where you could see, depending on what you're buying, a little bit more downward pressure before they become good investments. And you saw that happen during COVID. Companies like Zillow, where Zillow was getting into the home flipping business, that all blew up on them. They had to sell that business at a huge loss. And then Zillow got to the point where it was trading for 13, 14 PE, and it ripped off the lows. Same thing happened to Zoom. A lot of those COVID-related companies that you saw during 2020 and 2021 that traded at these super high multiples, they had that initial first drop, and if you bought them at that first drop, they weren't that good of investments for about 3 or 4 years, but then eventually they did become good investments. That's what I think this list is going to represent. So you've got companies like Trade Desk down 82%, you've got Gartner, Coinbase, all real companies. A lot of earnings in most cases here. Adobe, which is a really interesting example, down about 60%, trading a forward P of 15. Adobe for years traded at 40 or 50. Now you can buy that stock at a 15. I'm not saying you should go buy it. I'm just pointing out the fact that it's down a significant amount. FactSet, the data company, down 60%. Used to trade at 30 or 40 P, now trading at 12. You've got Workday Service now. Look at H&R Block here. Everybody thinks that H&R Block is cooked with AI. Down 55%, trading at a 7 forward PE. Here's Salesforce, a company that the Dow replaced Exxon with in 2020. They said that we were never going to need oil ever again, which was a crazy idea. They sold Exxon at lows, and they bought Salesforce, and now Salesforce is down 50%. You would have bought it in 2020 about 60 times earnings. Now you can buy it for 20. Look at Uber here. Everybody thinks that driverless cars are going to push Uber off the face of the earth. Down 28%, company that's growing over 20% a year with a forward PE of 14. So again, not every one of these is a screaming buy right now, but I'm just pointing out the fact that there has been a significant sell-off in tech, and that's what's driving some of the top 50 lower this year in 2026. I think a lot of it really will turn out to be an overreaction. And the reason why I think that is if you look at Microsoft, which is, this is a slide that I did use in a previous episode, but I just want to show this to you one more time. Microsoft today is in this 30% correction in 2026. But look at some of the corrections we've had in the past. July of 24, we were down 23%. July of 23, we were down 13%. In November of 2021, we were down 34%, more than we are now. That was the re-rating when the Fed came in and started hiking interest rates, and all the valuations on tech companies dropped back then. That's what I think we're seeing today. February of 2020, this was COVID. We're having a worse correction on Microsoft today than in 2020, where we shut down the entire world. Again, who knows if we'll be right in 6 months or a year, but to me, that seems like an overreaction. October of 2018, Microsoft in an 18% correction. Here's a couple other stocks that you may have forgotten about that had massive, massive pullbacks. Amazon in the tech bubble went down 90%. How many people sold their Amazon stock at 80 cents a share? That's the adjusted cost basis on Amazon in 2001. You could have bought that stock for 80 cents a share. How many people sold that thing and regret it now with Amazon back over 200 a share? Look at Morgan Stanley during the financial crisis, 07 to 08, down 80%. Here's Meta, down 74% during that Fed rate hike cycle. People said it was over for Meta. Nobody was ever going to use Facebook again. Down 74%. That thing ripped off the lows at $90, back up to a high of $7.90, if you can believe that. ExxonMobil. People said that we were never going to buy oil again. EVs were going to take over. Exxon was down 64%, traded under $30 a share. I hope you didn't sell it then. NVIDIA, down 46% from 2018 to 2019. Sherwin-Williams, the paint company, down 40%. JP Morgan was down 36% in October of 2021. So my point to you is these large cap companies that actually become very, very good investments long term. If you had a portfolio of Amazon, Morgan Stanley, Meta, ExxonMobil, NVIDIA, Sherwin-Williams, and JP Morgan right now, you'd be thinking that you were a genius investor. Well, at the time, each one of these companies had a reckoning in the stock market. And if you couldn't handle these 10, 20, 30, 40, even 70, 80% declines, you would have never made money as an investor. So what I want to just explain too is the fact that if you can't handle a 10% correction, if you aren't prepared for a 20% correction, if you're not prepared for an 80% correction, you should not be in equities. Because long term, over the course of a 100-year cycle or a 50-year cycle, you are going to have these scary times. And it's important to remember that all of these stocks, every single one on this list in front of you, has posted massive, massive growth. In fact, in the case of a Sherwin-Williams, it's posted 36,000%. Yes, that's a real number, 36,000% growth since inception. So these companies are good investments, but you have to be willing to live through the bad times. Now, here's that World War III trade I mentioned that I wanted to show you. This is what's happening year to date in 2026 compared to the 15-year averages. If you look at silver is up 19% in 2026, but the 15-year average is only 6%. Gold is up 18% in 2026. The 15-year average is only 8.6%. Lockheed Martin up 36%. Now, Lockheed Martin is a real company with real cash flows and real earnings, so the 15-year number has been quite good, actually better than the S&P 500. But Lockheed Martin this year is up 36%. ExxonMobil this year up 23%. The 15-year number, yes, including the dividend, is still only 5.36%. Here's the U.S. dollar relative to the euro. And this is what drives a lot of international market returns. And it's also part of the World War III trade, as people think that the dollar should be a little bit weaker. The dollar is down a little bit in 2026. But over the past 15 years, and this is actually a positive sign for the dollar relative to the euro over the past 15 years is actually up 23% total return. So again, these aren't the long-term trades that people think they are. They're not buy and hold trades. They're just that. They're trades. They look good in the moment. They look good in 2026, for example, but they don't necessarily look good over the next 10, 15, 20 years. They certainly don't look that great the past 15 or 20 years, with the exception of one being Lockheed Martin, which is an actual operating business. Now, what I want to show you here, and this is sort of a joke. I put this in on the last piece, and Owen, if you can put this back on the screen for us. I wanted to think about what would it be like to invest in a backyard bunker. And you're thinking, we're going to get nuked by North Korea in 2018. We're going to get nuked by Iran in 2026. We're going into World War III. Whatever you're thinking is, Donald Trump's going to take us out, or back when Biden was president, President Biden's going to take us out. Whatever your narrative is, let's just say you started building a bunker in your backyard. Well, I would imagine it would go like this. In 2026, you'd be up a bunch. You'd be up like 500%, and everybody would be like, "Oh my goodness, you are so smart. You were the guy who had the ability to see in the future. You looked into the crystal ball and you said, I got to have a bunker in the backyard, and now that looks really good." But if you actually do this and you look at it over the past 15 years, I would guess the return on your backyard bunker has probably been negative 90%, and I'm going to show you why in the next slide. So here's the idea of building the bunker in your backyard. The first year you invest, I don't know, this is a fancy bunker. You build $1 million bunker in your backyard, and it is really nice. You stock it with the meals ready to eat and the canned food, and you've got a little TV in there and satellite, and you've got your radio system and all that. So it is really fancy. But year two, you're thinking, well, no nuclear war this year, so you have a zero return. There's absolutely no reason to have the bunker. Year three, zero return again, no nuclear war. Year four, no nuclear war again, $0 return. And then year five, you realize, oh my goodness, all my MREs, my canned food is expiring, because it only has a 5-year shelf life. So I've got to go back into my bunker now, get all that old canned food out of there, and buy new canned food. And that's going to cost you about $25,000 to restock for the next 5 years. So now you're down $1,025,000. Year six, no nuclear war, zero return. Now, finally, we get to year seven. And let's just say it's this year, 2026, and this is the one. Okay, now we're going to get nuked by Iran or whatever. Okay, now your bunker is coming in very handy. But does it really matter? Because now you emerge from your bunker and it's desolate everywhere. It kind of looks like zombie land. It's there's nothing there. There's no Jewel Osco or HEB to go to. There's certainly no Costco. You've got your gold bars and you're trying to trade them with people, but they don't have food. There's no gas because Exxon got also nuked off the face. So you're thinking to yourself, this bunker that looked really good on paper, I sunk $1,020,000 or $1,025,000 into it, where I could have just put the $1 million in the S&P and made $950,000. So this goes back to this quote that I heard, and I just can't remember who said this, but this is one of my favorite quotes. It says, "Be careful betting on the end of the world. If you're wrong, you lose a lot of money. If you're right, it won't matter." So the World War III trade is kind of a silly idea at the end of the day, because what you're betting on is complete annihilation of the world. In that case, if it does happen, great, you're still alive in your bunker, but it doesn't matter because your portfolio is not going to be a concern anymore if we get nuked. So just put this into context and think about the reality of what's happened with entrepreneurship over time and what's really been the right move, which is to be an optimist. Now, people are bringing up gold to me. So I wanted to pull up the gold chart. And yes, gold has been just an incredible investment the past 2 years, 3 years, and especially again in this year, up another 18% like I showed you. But what happens with gold is every single time it peaks like this, it proves that it's a speculative tool. Gold does not have cash flows. It does not have an operating business. There's no revenue. There's no management team. There's nothing that's going to turn gold into an operating business. So gold, silver, precious metals, all of these World War III trades are in fact not investments, but they're trades, they're speculative tools. And I'm not saying that speculation doesn't work out sometimes, but it's just that, it's speculation. And I think what's going to happen is very similar to what you saw in 2011 when the US dollar is weak again. Gold and the US dollar move very, very closely together. Eventually what happens is people come to their senses, the dollar regains its traction like it always has, and it peaks. And if you buy gold at the peak, look at what happened to people from 2011 to 2017. They had absolutely zero return on gold. And it's not like a stock where at least you have buybacks and you have dividends and you have some sort of cash flow to keep you going through the tough times. When gold goes down, it really goes down quick. And by the way, if you take out this most recent spike in gold the past 12 months, and you just take out and you go from 2011 all the way through today, gold's real return has only been 4.2% per year, which is basically a little bit higher than the rate of inflation. What's also beaten the rate of inflation? Well, it's been U.S. equities, it's been large caps, it's been the mega caps, which are up about 13 to 15% per year, depending on what index you're looking at. Much, much better than the return on gold. So just understand what you're buying and what you're doing, because yes, there is a little bit of an international pop going on in 2026. Yes, there's this World War III trade going on, but these are trades. These are not, in my opinion, long-term investments. And so I think when we get out of the woods and we actually go back to the basics of the market, which I'm going to show you on the next slide, when we go back to the math of the market, I think you're going to see that equities, especially U.S. equities, are in one of the best moments to buy ever. So here's a couple different time frames that we've gone through in the past. Remember, Stenger Family Office, now 45 years that we've been doing this now. In 1981, We were buying the S&P at 10 times earnings. Why? Which was really cheap, by the way. Why? Because the 10-year yield under Paul Volcker was 16%. And you remember some mortgages back then were priced at 20 or 22%. Some of you might had a mortgage like that. But the earnings yield on the S&P was 12%. And this is a really important metric to watch. This is how we buy stocks for clients in the portfolio at Stenger Family Office, is we reverse the PE ratio, which is price divided by earnings, and you do the opposite of that, earnings divided by price. That gives you earnings yield. And typically what happens, as long as earnings yield is higher than the 10-year treasury, stocks are a pretty good buy for the most part. Now, you might be asking yourself, well, Nick, if that's true, and earnings yield was only 12% in 1981, and the 10-year was 16%, how come stocks were such a good buy in 1981? And they were. Well, part of the reason is the direction of interest rates, not just what interest rates are today, but where they're going. Remember when Paul Volcker came into the Fed, he was raising rates initially and then started to cut rates, which started the best bond bull market we've ever seen, about a 40-year bond bull market through 2021. But it was more about the direction of interest rates rather than what they were at that time. So when you get a 10 PE on the S&P and a 12% earnings yield, the only thing you should be doing is buying stocks. That is absolutely the case. 1981 was one of the finest times to buy equities. 1999, now this is the tech bubble. You can see where the numbers started shifting. The S&P was trading at a 41 price to earnings ratio, and the 10-year, and this was the problem, the 10-year was at a 7% yield. And the earnings yield on the S&P had dropped to 3. This is one of the worst times to be buying equities. And in 1999 and 2000, Stenger, our team, the Stenger Group, we were buying more value-oriented companies, more industrials, more financials, companies that had better earnings yields than the general market. And by the way, you could have found companies in 1999 and 2000 and 2001 coming out of the tech crisis that were trading at 7% earnings yields, 8% earnings yields. And if you were buying those companies like ExxonMobil, for example, or Procter & Gamble, you did just fine. Now, 2011, you were buying the S&P at a 15 PE ratio. This is also one of the finest buying opportunities ever coming out of 08 and 09. The other reason it was a massive buying opportunity is the 10-year was only trading at 2%, but the earnings yield on the S&P had skyrocketed to 7%. That was one of the best buying opportunities you ever would have had in the S&P. And that's what we were telling clients at the time. We were saying, buy stocks, just don't ever look, don't even think of it, just buy stocks. And that turned out to be the right advice. And you look back all these years later now, and you could have picked up these financials dirt cheap. You could have picked up industrials dirt cheap and technology dirt cheap. It was one of the finest buying opportunities ever. Now, here's what gets really interesting. I'm going to show you a couple more time periods here, 2021, and then I'm going to show you 2025 last year. But 2021, we were trading the S&P at a PE ratio of 36 times earnings with a 1% 10-year and a 4% earnings yield. So a lot of people didn't look at all the data here. They were just looking at P ratios in 2021. They forgot to look at the direction of earnings yield and the direction of interest rates. Yes, interest rates were going to start, they were starting to climb by 2022. However, earnings yield on the S&P was still higher than the 10-year treasury. So buying stocks in 2021 actually turned out to be a pretty darn good move. The only caveat to that was it was better to buy large caps that had higher earnings yields at the time than small and mid caps. And that was the key difference. So it wasn't the entire market that did well. It was specifically these large caps with great earnings yields. Then in 2025, what happened is earnings grew, especially on the large caps, and P ratios dropped to 25. That's why you can't just look at PE alone. You have to look at the direction, the future of all these things. That's why we always want to tell you tomorrow's news today, not backwards looking like the media, but forwards looking into the future. And if you looked at the 10-year in 2025 at 4%, and you looked at the P ratio 25, some people did say the market was overvalued. They missed that run last year where the S&P returned 17%. Why did they miss that run? Because earnings yield was coming in at 4%, and also because the 10-year was expected to drop. That has not happened yet. So here's 2026, and then I'm going to show you where I think we're going in 2027. In 2026 now, we're actually trading the S&P a little bit lower on a PE basis, on a valuation basis, than we did in 2025, and certainly lower than 2021. So you're buying stocks cheaper today than you did during COVID, and the market's still up about 90% the past 5 years. So think about that. Market's up 90% the past 5 years, but you're actually paying less for those earnings today than you were in 2020. And here's why. The 10-year Treasury is still stubborn at about 4%. Earnings yield's about 4%. But again, it's more about the direction of where we're going. So if you look at, this is in yellow here on the screen, I highlighted this just to point this out. If you look at where earnings are supposed to come in for 2027 now, we always trade a year in advance. Markets don't care about yesterday, they care about tomorrow. If we look at earnings estimates for 2027, you're actually buying the S&P today at 19 forward PE. It's not the cheapest it's ever been. It's certainly not 1981 pricing. It's not 2011 pricing. It's not 1960s pricing. But it's certainly cheaper than where we were 2025. I think cheaper than where we are today now in 2026. It's cheaper than 2021. And it's a lot cheaper. It's about half as expensive as it was in 1999. The 10-year is still at 4%. I don't think that's going to change a whole lot, so don't expect a lot of movement on yields. Mostly just status quo from here on out. But the earnings yield now in the S&P is starting to climb back up to 5%. So you have what I believe is not the perfect environment for growth, not the most spectacular environment for growth that we've ever had. But I think it's one of the better buying opportunities that we've had in the past 5 or 6 years. So again, just stay grounded on your plan. Remember that in the end, the math will win. The data is going to prove to be right. That's how we build the portfolio. Don't get wrapped up and caught up and lost in the sauce of this World War III trade, this temporary adjustment towards value stocks or this trade towards industrials or everything else. These are great things to see. The sector rotation is good to see. But when it's all said and done, you're buying the overall market today, which is still heavily dominated by technology, at a very reasonable price. Not the cheapest point ever, but a very reasonable price nonetheless. So stay bullish, stay optimistic. I believe markets are headed higher from here. However, we may have a little bit of a pullback between now and the midterms, which is very typical of a midterm cycle. So stay tuned. You could see another 5% off in the S&P. You could see another 10%. Just keep buying all the way down. You may see us do some additional rebalancing to take advantage of that. If you're still working and you've got 5+ years to go, it's the best possible thing. When you see these corrections, you can buy cheaper than ever before. So just stay on your plan. Stay optimistic. And I think when we get through the other side of this, as you look back in 5 years or 6 years or 7 years, and we put these numbers back up on the screen, you're going to say that was one of the best buying opportunities that we had. Thank you for being on for episode 213. Stay grounded on your plan. Give us a call if you're thinking about jumping off the ledge here, and we will talk you off. And we'll see you next time for episode 214.